let's kick straight off. I know there's going to be, inevitably, there's going to be a little bit of an overlap with, I think, in terms of content, with a similar session that was held yesterday. But I believe there's an important question that we could kick off with here, and I'd just like to garner the panel's comments on this first. But before we do that, why don't you guys just introduce yourselves quickly before I forget? Alex.
Alex Foster. I work at BT for financial services, and I have the pleasure of setting up our strategy and our business development for that market segment.
Hi, I'm Brian Pomeranning. I run electronic client solutions and liquid markets products at JP Morgan.
I'm Vincent Moyer. I'm responsible for equity trading at PGGM in the Netherlands.
I'm Gianluca Minieri. I work in trading in Pioneer Investments.
Excellent. Right, so the question that I wanted to carry over from yesterday, just to get this panel rolling, is the fundamental one of, we're hearing lots of talk about models changing, coverage models changing, not just within equities, but possibly across asset classes as well. And I think the one important issue to dig into initially here, at least, is this something that's being pushed on money managers by their brokers, by the sell side, or is there a demand for these types of changes from the buy side? So is this forced upon the client by, say, cost pressures, or is this something that the client actually thinks is better for execution quality? So, Alex, would you like to kick off?
That's an interesting one for me to answer, particularly in the space that we sit in. I think the changes that we are seeing is both a push and a pull model. And I think some of that's around changes on the buy side, where buy side are wanting to take some of their own technology responsibility. And as a consequence of that, you're starting to see the buy side say, well, actually, what do I need from the sell side? What do I need to do from a regulatory pressure myself? Because I think that with some of the new regulation coming in, for the first time, you've seen the buy side having to take responsibility for that. And as a consequence of that, they're starting to say, right, well, if I've got to take responsibility for trade reporting under EMIR, well, what else do I have to do, or what else could I do? So there's both a push and a pull. And as a consequence of that, you're starting to see technology that was being used predominantly on the sell side before starting to be used very much by the buy side. So whether it's collaboration tools to be able to have those conversations with the portfolio manager, or having a differentiated conversation with the sell side, at the same time using some of that cloud technology to be able to interact with the venues in a way that had been on the sell side. So both a push and a pull model is what we're seeing. Okay,
Brian, are you pushing it on people, or are they coming and knocking at the door and doing it?
We're not pushing. I think there's a little bit of knocking on the door. I think you look what happens in the market and the chaos of the equity markets in the past 5 years. There's been some experimentation going on the sell side in terms of what's the most appropriate model. I think most of that experimentation has pretty much received mixed reviews from customers. So I think the traditional model still stands today. I do see from some clients, and it's a very small fraction, that they've come to us asking to lower the barriers between high touch and low touch. And we've mainly accomplished that through technological means, specifically for those clients and no others. So if you ask, we have the ability to do it, but we don't typically market that out to our clients.
Okay, gotcha. Vincent, what's your experience here?
Well, I think in the recent years there's been a lot of changes. First of all, we went from having paper tickets on the desk to having all the power at my desktop to execute trades ourselves. Then we have more cost awareness from our clients and from portfolio managers. And at the same time, everybody has to do more with less. So we have to, from both sides, buy side and sell side, come up with a different structure, a different way of looking at this partnership. And we have to be, on the buy side, more clear on what we need. And I think from the sell side, they have to think about a different business model, because now they're running a lot of little shops within one firm. And for us, it is sometimes difficult to find the right place where to go to get the liquidity and the information we need in a efficient, in a simple way, and we want to pay a fair price for that. And I think we are now trying to find our way in that new environment.
Okay. Gianluca, are you demanding your brokers change, or are they coming to you trying to encourage you to see things their way?
No, my opinion is that most of the changes are industry-led. I mean, the reality is that the buy side is growing and the sell side is shrinking. And that's a fact. I mean, as of December of last year, there were 12 asset managers with more than $1 trillion under management. So that tells you that that's a reality. So I think it's a push, but it's a push from the buy side. The buy side is taking more control over what they're doing. As you said, we are taking more control over the technology. We're taking more control over the way we execute our orders. We expect more transparency from our broker in terms of where are they going to execute our orders. So I think it's a push from the buy side. The sell side is adjusting to this position. It's adjusting to this new reality in a budget-constrained situation where they need to reorganize their team. So I think it will be a matter of rethinking our relationship. So it would be more a partnership relationship going forward than the old one where the broker is telling us basically what to do.
Yeah, I mean, there are two sort of main themes in this. One is about, is coverage still king? Coverage certainly hasn't died like it was forecast to 14 years ago. And there's also an assumption that, you know, in the integration of high and low touch tools should happen. Just picking up first on your point though about the size and scale of the buy side and how that's changing. You know, I mean, 10 years ago at a conference, I heard the sort of marvelous analogy of, you know, look, when a large institution comes into the market with an order, this is the equivalent of an elephant trying to tiptoe through a party, right? What we've got now is an elephant trying to tiptoe through the party with a tutu on, blowing a trumpet with a bass drum on its back, yeah? It's just getting harder and harder and harder. Is your coverage guy, your high-touch sales trader, the fundamental point of value in your broker relationships?
Well, a few years ago, where I spoke at conferences, I used to say that I work for a large asset manager. I think I need to say now that I work for a mid asset manager, as we manage just 170 billion of euro. We have a long list of broker relationships, but I have to tell you that the broker that we have restricted are the global houses. Instead, the high touch is still a great value to us, because when we enter the market with the large orders, we still feel, you know, that our clients are better protected with the high touch or in the dark. We just mentioned the dark in the previous speech, because there is a proper level of confidentiality, because we can get a decent part of our order done at a good price. And there is a good quality market information that they can provide to us. But the local, you know, the type of high touch where you get the local expertise, you get an edge on local markets, is still the value. So we are now enlarging the list of local broker, where we really need to pick up the phone and look for liquidity.
Vincent, you've probably got a sort of different style of trading perhaps, and are you seeing the sort of demarcation and the relative values of high touch, low touch services changing?
Yeah, but what is my frustration in the high and low touch is that if I have an order and I would give it to high touch, I'm afraid of information leakage, so I will just give a piece out, and I'm not really getting what I want. I want to have access to all the liquidity in the firm and all the knowledge in the firm. Now, if I go to the low touch to be under the radar, I don't get access to that guy who is trading the stock for 20 years, who knows exactly what's going on. And the algo is not going to give me a phone call saying, have you seen this or that? So I'm looking for that mid-touch where I still can access that knowledge of the high-touch guy, but I can be more or less less afraid of the information leakage. And I want to access all the electronic systems as well. Now, just as an example, there's one, I'm not going to give any names, but there was a broker who has an Alco, and I just saw a new option that says check in the box, high touch. So I was like, okay, so what's going on if I check the box? Well, then your trade is also flagged by the high touch desk. So if there is any liquidity, they can interact with that. So I thought, okay, that's a good idea, because I saw they have an IOI. I'm checking the box expecting that I get a fill from the IOI, but I didn't. So I was like, okay, why is that not happening? So the explanation was like, okay, but they're not going to fill you because you're paying low touch fees, and we want a high touch fee. So I have to pull part of my trade and send it to the high touch guy anyway. So just the old way. And I think that is not what the technology should do. I want to pay a fair price, but it shouldn't. It should come naturally in an easy way. In a one spot, I should get all the liquidity and knowledge of the firm, and I should not be shopping around at one broker place to get my needs, basically.
Okay, so Brian, we got two themes coming out there. We got one, a question of trust. I mean, a lot of this all boils down to who can you trust. And as Vincent says, there's an inherent fear in a lot of cases that if you go the high touch route, if you show your hand, there's going to be more impact in the market. You know, and the second theme is that there's a cost margin profit issue here to have these guys who know the market, know their stocks, know where to find the other side, who've been doing this for 20 years. That's expensive. And what we see in the market is a trend that the whole swathe of equity business has gone electronic, cheaper. The buy side are doing far more of this themselves. They're finding it harder to do blocks. They've actually got less business that they can give to those expensive guys to pay them. So as a broker, you've got the cost profitability issue of having that high touch model. You've also got a trust issue that you need to overcome. So what's happening there to address these?
So I think I'm going to address the economic side of things first, and then the trust side of things second. So in terms of to me, that sounds like a distortion in the way the economics are set up at the sell side firm, and I think that that's a common problem we have on the sell side, in the sense that a lot of times these different fiefdoms have been set over years, and there's high touch, low touch, and PT. And in order to get information or something from one of them, you need to do business with them, and that's a major problem. I think we need, at JP Morgan, I can only speak for JP Morgan here, we've made some major strides in that, and I think we're in the best place we've ever been. We have a model in place where it doesn't matter, it's more of an execution services model, where it doesn't matter how you pay the firm, you still will get access to any one of those execution channels. So, and the individuals in the firm across all of those, no matter if you trade low touch, there's a possibility that the PT trader will still, or the PT sales trader will still get paid, and there's a possibility that the cash sales trader will still get paid. So there's basically an economy that's been set up within sales that allocates the commission revenues back to the various parties. So I think having that in place promotes a lot more collaboration and cooperation across these businesses. And with that respect, we can then go out to you, the client, and have a more unified approach to our product offering, which hasn't been in place, I think, for quite some time.
It's quite interesting hearing Brian talking about that collaboration across the desks, and you were just talking about, Vincent, there, that mid-touch. A few years ago at Trade Tech, I think people talked about broad touch. And I think that one of the things that we've certainly seen and heard and responded to is how do you get high touch and high touch technology into a low touch automated environment. And actually one of the things that we're doing at Trade Tech at the moment is launching the BT Netrix high touch product, which is that wonderful trinity of human interaction with all of the applications and feeding back into cloud environment, but at the same time being able to have the conversations and be able to negotiate with other parts of the business. So you really get that feel of high touch, whether it's you wanting to speak to other parts of the desk, being able to speak to portfolio managers, whether it's speaking to researchers, to be able to get that richness, to be able to have, just as you were saying, Gianluca, that you wanted to get. You wanted that local guy with that local feel, being able to do that, but at the same time, having the applications integrated into the cloud so you can have the richness of trying to find the liquidity outside of that high-touch environment. So very much high-touch integrated into a low-touch automated environment.
On the face of it, if you were an outsider looking into this industry and you said, look, there's all these gizmos and technology that enable you to work certain types of orders into the market, and there are also these guys who might know about blocks, who might know about intentions, they could be very close to their clients and understand what they've been trying to do, what they've been doing over previous months, positions they're trying to build or get out of. And if you, if you allow those two to interact, you think, well, obviously, I'm going to have more liquidity opportunities. And the only thing that could possibly interfere with this is if the broker's not handling conflicts of interests correctly. So this ought to be the norm, but it's not. So, Vincent, Gianluca, any?
I mean, the point is, what is the technology giving to us? I mean, working on behalf of long-term investors, I would like only to interact with naturals. And at the moment, the technology is not helping me in this way. And that's the reason why we go and still look for dark, we look for people that have natural blocks. So my answer is, I mean, the position we have is that we don't want to interact with those people because it's not about, you said liquidity. We're not convinced that technology and HFT guys are generating liquidity. We're thinking they're generating shallow volumes that are they are useless to us. So we will keep looking at technology as far as it will meet the demand of our clients.
But are you saying that you don't trust the technology that's used for delivering IOIs? And if you've seen an IOI and it's now marked natural, do you believe that?
No, I mean, at the moment, the amount of the fake IOIs that are in the market is phenomenal. And so brokers should be banned by advertising false IOI. Because we personally in Pioneer ban brokers from our broker list for 6 months when we found that there is a fake IOI. This is our internal policy. I think this is something that the market should adopt. So that's really...
So you do cut off the nets if you find people fishing?
Yes.
Very popular. Vincent, join in with the popularity. What do you...
Well, if we have to cut off all the false IOI brokers, then we end up with no brokers at all. So that's a bit of a problem. But no, I came to a point where I don't find IOIs indeed not so important anymore to my day-to-day process.
Okay.
I just tend to not to believe it. And if there's already one out there, they all have some kind of disclaimers where they show limits, small volumes, and working, whatever that means. And so there's a lot of fishing out there. And in a way, I'm not so strict that I only want to interact with naturals. I just want to get the trades done, and who I'm interested in, it's not that important. I just want to be unpredictable and be having the best price under the certain circumstances. So interacting with HFT, I'm not sure if it is a bad thing for us. I mean, maybe we pay up a little bit. Maybe they are making money out of us, but at least we get liquidity in return.
Right.
And now we are seeing countries like where we are today having all kinds of financial transaction tax, where they claim that maybe chases away some of the high frequency trading. But then I know for sure I'm paying the bill to the French government and I'm getting nothing in return. So I'm not sure yet whether it is a good or a bad thing. It provides a lot of liquidity for us, and that is for us very important just to get the job done.
Brian, I'm not suggesting you're a salty old sea dog, Captain Birds or anything like that, but this isn't JP Morgan specific. Clearly the sell side are still out there, trawling everywhere they can, fishing with IOIs. Now, this is a perennial problem. Isn't it just a bit sad that the market can't police itself? I mean, surely if the buy side actually did something about this, as in you're cut off. Not just, I'm not going to ignore your IOIs, I'm not going to respond to a call. You know, if you're going to do this, then it would sort itself out pretty quickly. So what is it about the sell side that seems incapable of understanding this message? It's been consistent for 15 years, 20 years.
Yeah, IOIs have definitely become the junk mail of the financial industry.
Yeah.
I think their value is I can't say completely worthless because there are quality IOIs out there, but it makes it very difficult to identify which ones are quality and which ones aren't. So, I mean, there's definitely been a major push from clients both in the US and in Europe to clean this process up. I think what's somewhat interesting in the US, we just ran a project where a number of our competitors are already doing this, is actionable IOIs. And actionable IOIs means you could theoretically go and hit that IOI, but typically they treat that as you pick up the phone, call your sales trader, and do the deal, but you know that there's something there. Right. And I think a lot of what we're going to see from a lot of our customers, there's actually a filter on Bloomberg now where you can filter out everything else except for the actionables. So I think that's one way that we've seen to kind of clean up this process. And another way, which we've started here within Europe, is we have a central risk book set up where we manage all of our liquidity from the cash desk, and we generate IOIs directly off of that book. And we try to refrain from anything else from phishing from individual traders. Yeah. So I think that should help. There's definitely demand from pretty much every customer we talk to in terms of
Alex, before I bring you in on a technology question, I just want to ask you guys, I hope this isn't sort of rude in any way, but do you think you pay enough to your brokers for this high-touch service? Do you think, I mean, obviously there's been a huge focus on rates, and as DMA came into the market and algos and so there is, I mean, it was mentioned yesterday, there is a desire amongst the buy side, and still a desire and an intense focus on what is it costing my broker to trade, therefore what should he be paying me? Now, it doesn't seem to me that a cost plus arrangement is necessarily the right way of paying for a high valued relationship sales trader. So, like the legendary restaurant in London, if the customer, no price on the menu, but if the customers don't actually pay enough, it will shut down. Do you think the buy side have just gone too far on rates?
No, I don't think so. I mean, there is a trend that is going on in the industry, which is the unbundling, as you might know, and most of the big asset manager on the buy side are going into the unbundling environment, where they will be willing to pay to the broker only the execution rate, but on the other hand, they are willing to pay what the coverage, basically. And that will completely put a segregation between execution and coverage / research / market callers, flows, and so on. And as far as brokers will be able to show the value of what they are providing to us, we will be willing to pay.
Right. So that does indicate that. I mean, unbundling probably will happen in some shape or form. It's a trend. It's going to continue.
It is already happening.
Yeah. So presumably, therefore, you could see an environment in which there's no actual fixed rate for a sales trader. As I mentioned yesterday, if he manages to find you 2 days volume in a Lithuanian stock that you want to get out of, then that's worth 100, 200, 300 basis points. Potentially. Brian, I'm trying to make you smile.
Yeah, it sounds great to me. It won't happen. I mean, we've been experiencing commission compression since I've been born. Right? I do think we've reached a point now where there's not much lower we can really go. I do think what potentially will happen at some point, in my mind, is okay. You have these execution service models set up across the street. You have your choice of deciding how you want to execute across cash, PT, or electronic. You, the client, make that decision. And why aren't we thinking more along the lines of a blended rate to pay for these different services that you get from the firm? So you pay one rate across all channels. You decide how you want to execute.
Okay.
To me, I think that's more the direction we're going to go. We can only go so low before, like you said, having to close the restaurant.
Alex?
Before you ask me, I just wanted to pick up where you talked about different methodologies and seeing, IOIs or seeing flow. I think that one of the things we have seen recently is you've seen new applications come out, so the Squawkers of this world, to try and, work out how you get trust back into the market. And I think you're seeing applications that you've seen in other asset classes where it has been much more voice put within an electronic environment. So therefore the sort of request for quotes. So you're seeing sort of R&D and innovation from other asset classes coming back in, plus starting to use technology to actually help bring trust back into it. So whether it's around federated identity, who you are, what does that mean for you? And we've been working a lot.
That was sort of going to be my question to you, because the fact is, if you look at a high touch sales trader's desk 15 years ago, and a block trader on the buy side, and you look at their desk today, not that much has changed, right, compared to all the investment and technology that's gone into handling the shrapnel, handling programs, Delta One. The block side of the business is handled in much the same sort of way. What's your process? Well, I'll look at the IOIs, and then I'll go to that venue that begins with L, and then I'll go to all the other dark venues, and then I'll think about maybe putting a call in. So is that an area that you feel is ripe for innovation?
Yeah, absolutely. I mean, considering we're an organisation that sells products predominantly about, voice, we've actually been listening to clients, and clients have been saying exactly that you've had a lot of innovation up at that top set of the screen, but actually in terms of, your control, your console, your Starship enterprise part of it, that's where clients have been looking for innovation, and that's exactly what we've been listening to and delivering back to clients. And so exactly, putting applications where you can have trust, where you can see somebody's face, makes quite a lot of difference, doesn't it, when you can look into somebody's eyes and see them. So actually, if you're using, a BT Netrix high touch, and you've got that video, and you can see Jian Lanku on one side, and you can see Brian on the other side, you have inherent trust because you see each other, you see the whites of each other's eyes. You can have
all
that.
The reds.
All the reds, yes, especially if anybody been out in the bars last night, yes. But you've got that implicit trust there. At the same time, you've got trust around, bringing in BT Unified Federated Identity, so you know who it is that you're working with. So, both from a multimedia, both from bringing in video, bringing in collaboration, you start to have quite a lot of tools that have been used in other industries or other parts of the market suddenly coming right in to provide that trading console for you. So, you can have your own Starship enterprise.
Very good. I'm going to look at you lot now, because I know I'm keeping you away from the coffee, and my coffee's going cold. Have we got questions from the audience to the panel on this topic? Yep. Mr. Barnes.
Thanks, Richard. Dan Barnes, journalist. I was just wondering if the buy-side guys think they're being well represented enough by industry associations to push the issues and concerns you have around trust back to the sell side.
Well, I don't think it's a matter of being enough represented. The MiFID II experience, for example, has been quite a frustrating one for us. We were really well represented, and we have met with policymakers many times in Brussels. The problem is they haven't listened to us. So I think we have made it very clear with formal letters where we have given to the European Committee our priorities. And we made it very clear the buy-side position. So the answer is yes, we were well represented. The problem is we haven't been listened.
Okay. Any more? In which case, I think we'll draw proceedings to a halt and give you time to refresh yourselves and enjoy a coffee in the main foyer, and no doubt.